Ladies and gentlemen, good day and welcome to the Pritika Auto Industries Limited Q4 and FY26 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Harpreet Singh Nibbar from Pritika Auto Industries Limited. Thank you, and over to you, sir.
Thank you, ma'am. A very good afternoon, everyone, and welcome to Pritika Auto Industries earnings call for the fourth quarter and the full year ended March 31, 2026. I would like to begin by expressing my gratitude to you all for taking the time to join us today. I have with me on call today Mr. Narendra Kumar Tyagi, Director Finance and CFO, and Adfactors PR, our investor relations team. We have shared our results updated the presentation and media release. I hope you all must have received it and gone through the same. I would like to share a brief insight about the company's performance for the year and our strategic outlook going forward. At Pritika Auto Industries, we have established ourselves as a robust and reliable brand specializing in manufacturing of machine castings and automotive components. With the history dating back to 1974, our journey has been guided by the visionary leadership of Mr. R.S. Nibbar. Over the past five decades, we have grown into a prominent player in our market, supplying high-quality components to leading original equipment manufacturers, primarily catering to tractor and commercial vehicle segments. Our manufacturing facilities at Deravasi, Hoshiarpur, Mohali and Taliwal continue to operate at healthy utilization levels, with total consolidated installed capacity in excess of 72,000 metric tons per annum. Production volumes for Q4 financial year 26 stood at 14,193 metric tons, taking the full year F26 volume to 52,620 metric tons, the highest in any single financial year in the company's history, underscoring the consistent capacity ramp-up and operational throughput improvements we have delivered across the year. Our focus on low-cost mechanization and targeted automation has allowed us to expand effective throughput by approximately 10% annually without disproportionate capital outlay, keeping us agile and cost competitive. The high-weight casting segment, known as large castings like gearboxes, transmission cases, differential carriers, continues to be the primary driver of our product mix improvement. Higher value products carry better realization and margin profiles, and we are directing incremental capacity additions in this direction. Our core OEM relationships remain intact with M&M Swaraj, TAFE, Escorts Kubota, Ashok Leyland, Case New Holland, and Kion continuing to anchor our order book. The tractor segment, which is our largest served market, saw healthy retail demand through financial year 26, supported by favorable monsoon, rural income stability, and GST rationalization by the government. Our ability to reliably service large repeat volumes requirements for top-tier OEMs remains our most durable and competitive advantage. On railway diversification, which we have discussed in earlier calls, product development and qualification work continues. Revenue from these segments is not yet material, but we expect initial contributions to begin occurring in financial year 2027. This vertical remains an important medium and long-term growth lever, and we will meaningfully diversify our customer base beyond the traditional automotive OEM universe. I would like to update shareholders on a few corporate developments during the year. In April 2026, our subsidiary Pritika Engineering Components Limited completed the first tranche of an investment in Omni Engineering, delivering corporate entity acquiring 100% stake for $50,000. This represents the initial tranche of a board-approved plan to invest up to $100,000 in Omnia, which is a newly incorporated company yet to commence operations. The strategic intent is to establish foothold in the US market and to explore engineering sector opportunities over time. This is an early-stage initiative, but it marks the company's first step towards dedicated international market participation. As we enter financial year 2027, the medium-term revenue target of rupees 600 crore remains our reference point. We believe it is achievable through a combination of volume growth from existing OEM customers, scaling high-value products, and railways beginning to contribute meaningfully. The company has outlined strategic capex program for financial year 2027, focused on capacity expansion, product development, and efficiency improvements. Guidance on phasing and quantum will be provided as plans are firmed up. Our capital allocation philosophy remains unchanged. We will invest where the returns justify deployment, and we will not pursue growth at the cost of balance sheet discipline. The macro backdrop remains constructive. Tractor demand fundamentals are intact for financial year 27, with monsoon outlook being a key variable to watch. Government infrastructure and capex spending continue to support CV demand. On the EV front, our served segments, tractor and commercial vehicles, operate on a materially longer electrification horizon than passenger vehicles, and we do not see any near-term structural disruption to our core business. With that, I would like to hand over the call to Mr. Narendra Kumar Tyagi, our CFO, to share with us the financials for the quarter and year ended. Thank you.
Thank you, CMD sir, and good afternoon to everyone. Now coming to our financial performance for the period. For quarter ended March 31st, 2026, the company reported consolidated revenue from operations of rupees 138.46 crore, reflecting a year-on-year growth of 36.20%, driven by healthy demand from our key OEM customers and improved production volumes. EBITDA for the quarter stood at rupees 16.64 crore with an EBITDA margin of 12.02%. Profit after tax came in at rupees 4.77 crore with basic EPS of rupees 0.26 for the quarter. For the full year, financial year 2026, consolidated revenue stood at rupees 482.95 crore against 356.89 crores in FY25, a growth of 35.32% year-on-year, supported by volume growth and a better product mix. EBITDA was 71.03 crore at a margin of 14.71%, and PAT for financial year 2026 was rupees 23.20 crore. We are pleased to note that FY 2026 represents our strongest annual revenue performance since listing. Though the first 9 months the company had already demonstrated consistent delivery, 9 months FY 2026 revenue was rupees 344.48 crore, up 34.97% year-on-year, with EBITDA of rupees 54.39 crore and PAT of rupees 18.43 crores. Q4 has built on this foundation, and we enter FY 2027 with a healthy order book and stable customer relationship. That's all from our side. We can now open the floor for questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We'll take our first question from the line of Udit Sehgal from Pinpoint X Capital. Please go ahead.
May I please repeat the name?
It is Udit Sehgal.
Udit Sehgal.
Yes.
Yes.
Yeah. Good afternoon, sir. So what exactly is the installed capacity and what is the maximum utilization we can go up to? Also, our EBITDA margins have been falling. So, I mean, what's the reason for that?
Hi. Installed capacity is 72,000 metric tons annual, and at present we are doing roughly 73. Maximum we can go up to 80-85%. We can go up to maximum 80-85%. We can go in this.
So we are already doing around 56,000. So there's not much room to scale it up further.
We are doing roughly 52,000. We are around 73-74%. And we can go up to 80-85%. And we are planning expansion this year. We plan to add around 7,800 tons this year.
Okay. And do you expect this 80-85% utilization to come this year, sir?
Yeah, hopefully, If market remains good, whatever the indications are as on date, we should achieve 80-85% this year.
Okay. And sir, regarding our EBITDA margins, they were in the 16-17% range. They've come down to 12% this quarter. What's the reason for that?
This is basically raw material prices have increased tremendously. And in month of March, because of gas and other things issues, it just took off.
So are these not like a pass-through? I mean, when we'll be able to...
It is normally done with a gap of 1 quarter.
Okay. So from this quarter onwards, we'll revert back to the normal, or will take another quarter?
We should revert back, and we should rather improve on that. Because capacity utilization, as the capacity utilization improves, the margins will also improve.
And with respect to this US entity that we are required, sir, what is the thought process and how do we see that scaling up?
The thought process in this is what happens is now all the major OEs, they have their offices in India operations, they have Indian offices are there. So, I mean, when we contacted them, they said if you want to deal with the USA directly, then you need to have a USA entity. So, for that reason, because the margins over there are much better than what the Indian offices are giving. So, to deal directly with US customers, potential US customers, we are opening entity over there.
So we will be doing the manufacturing there, or we'll be doing the manufacturing here? I mean, what is...
It would be manufacture here and take it over there, and then there is a thought process on that also. We might start acquire or start a manufacturing facility over there.
Okay, sir. Thank you. That's it from my end.
Thank you. Next question is from the line of Zuzair Hawailiwala, an individual investor. Please go ahead.
Hawailiwala?
Yes.
Yeah, hi, sir. Am I audible to you?
Yeah, you're audible.
Yeah. So, first of all, thank you for the opportunity. And my first question is, sir, how is the demand shaping up from the key tractor OEMs such as M&M, TEF, Export, and Swaraj for FY27? And how we are seeing any changes in ordering trends and or customer outlook?
As far as outlook is concerned, customer is expecting a low single-digit growth, around 6 to 8% for this year, because H2 will have very high base. So, but for ourselves, considering whatever new products, new projects we are having in hand, we expect to grow by around 15% this year.
15%?
Yeah.
Okay. And my second question is what is our plan for the capex for upcoming years like FY27 and FY28? And how will this investment roadmap support the company's long-term target of achieving 1 lakh tons of capacity?
See, this year we plan to add approximately 7,800, which will in H1. That is what we are planning, 7,800 metric tons in foundry, and for that we will need to add machining capacity also. So after this, I mean, so this will take our capacity to roughly 80,000. And then, as you know, around 2 years back, we ventured into a new technology in casting, LFC. So we have got a very positive results in that. And then next year, financial 28, we will add another 24,000 tons in LFC technology, so that our capacity, our overall will cross 1 lakh tons.
Okay, this is through LFC technology, right?
So this year it will be by green sand, 7,800. Next year we will add to 2,400 in LFC.
Okay. And are there any plans to increase the content per vehicle through more complex or precision engineered components?
Yeah, because we around 30, 40 years back when we ventured into foundry business in 1997, 98, we started with the small castings. Then slowly we gradually moved into medium castings. Then now we have started moving mainly into large castings, where the competition is less and value addition is higher.
Okay. And my last question is, what is our current mix between the machine casting and plain casting, and how do you see this evolving over the next few quarters?
We do 100% machine castings. We don't give raw castings. We do 100% machine castings. We don't give raw castings. Yeah.
Oh, okay. Thank you, sir. That's all from my side, and best of luck for the future.
Thank you.
Thank you. Before we take the next question, would like to remind participants to ask a question, please press star and one on your phone. Next question is from the line of Manas, an individual investor. Please go ahead.
Hello, sir. Good set of numbers. I think we delivered partly on the revenue side, and I think you said the margins is some kind of temporary pressure we went through. So I just some question on the margin. So next year onwards, we go back to average 15-16%, PAT level margin 5% next year. Is it a fair estimate?
Yeah. We should. If the war doesn't create much more disruption, then we should go back.
And the first quarter itself, we'll be able to see.
Because of war, what has happened? Everything related to crude, all the chemicals, everything, gases, everything has become costly. So if there is no further disruption, then I think that we should revert back to that.
Because I think I felt we should have got some operating leverage. The last quarter, the sales growth was too good. So it should have...
It was our highest ever sales growth.
Yeah. So I felt it should have resulted in some operating leverage, but somehow we got stuck up in this.
Because, raw material increased by around 4 to 5%, 6%, then other expenses, all the gases and manpower costs, everything... labor, contractual labor costs, whatever we were doing, getting in outsource, everything increased.
Correct.
There was a huge impact on that.
So now the current run rate, we're expecting similar run rate in line with the last quarter. We had 138. The first quarter will also be in the similar run rate.
First quarter will be similar to that.
Similar to that, and margins 15 to 16%.
Margin would improve, definitely improve.
From here. And one more thing I wanted to check out. We did around 70 crores of 70 crores capex, whatever cash flow we generated. We had put some capex. So where is this actually sitting? Is it for the 7,800 ton or is it separate?
Some is for 7,800 tons, some is and machining, and some is for new product development, and some for railways, whatever 3-4 products we are developing for railways.
So this year, what will be the capex requirement there?
This year capex will be roughly around 25 to 30 crores, 25, not more than that.
So for 7,800 ton, we require how much? 60 to 70 crores in total?
No, 7,800 tons, we require roughly 35 crores.
35 crores. Okay.
Yeah.
Okay. Got it. And one more thing I wanted to check up. For next year onwards, where are we sitting? I think I heard somewhere 600 crores and then 15%. So
yeah, next 2 years, we plan to grow at around 15%. So I think so with 15% growth in next 2 years, we should touch 600.
So 600 in next 2 years, you're saying?
Yeah.
So, okay. So now this year onwards will be around 15% growth.
Yeah.
With better margins.
With better margins.
Okay. Congratulations, sir. Good set of numbers. Thank you.
Thank you, Manav. Thank you.
Yeah, thank you.
Thank you. Next question is from the line of Pritika Deshpande, an individual investor. Please go ahead.
Hi, sir. Good afternoon.
Good afternoon, ma'am.
Sir, could you please provide an update on the Hoshiarpur land acquisition matter and its current status? Also, does this development impact company's expansion or capital allocation strategy in any way?
Pardon, I didn't get the second part of the question.
Does this development impact the company's expansion plan or capital allocation strategy in any way?
No, the status of land was that we acquired the land under from a ARC in auction by High Court. But then we found there was some litigation on this. So then we withdrew ourselves from the auction. So that we know, you know how the auctions go. I mean, they take 10, 15, 20, how this litigation goes, 10, 15, 20 years, recent developments have been there. So we thought it is better to withdraw ourselves from the auction. And this won't impact our immediate plans for next 1 or 2 years. Yeah, beyond that, we are looking for land, and we might acquire a fresh land, new land somewhere near in another 2 to 3 months.
All right. And sir, any refund initiation process?
We have received the refund. Refund has been received.
Refund. Okay, okay. All right.
Yeah.
Thank you so much, sir.
Thank you.
Thank you. Next question is from the line of Akash Sharma, an individual investor. Please go ahead.
Yeah. Hi, sir. Thank you for the opportunity. I have few questions, sir. First one is that our EBITDA per ton stood at around 30,500, while realizations per ton improved to around 92,000.
Yeah.
So just want to know that which segment or products are driving this improvement?
Which segment?
Which high value product segments are driving this improvement?
If you see, we are primarily general tractor industry has 3 category of castings. One is small castings, which weigh say 0.25 kgs to say 20 kgs. Then we get medium casting, which is say 20 to 80 kgs. Then above 80 kgs considered large castings. As we move in this segment from small to medium large, the value addition and the profitability keeps on improving. So, and we have been consistently moving from small to medium. Now we have started moving from medium to large. Large, basically the advantage with large is one more, that number of players in India is very less for large castings. Especially for giving to tractor industries, number of players is hardly 8 or 10 players are there who produce large castings in India. So we are, so there it's a slightly niche market, difficult market, and competition is less. So we are moving in that direction. That will improve our margins and everything.
Okay, sir. So, have we gained any market share with any major OEM?
Yeah. We have gained market share with almost all our customers. See, market has grown by 16-17%. We have grown by 34%.
Okay. Okay, sir. And what is the, approximate revenue contribution from our top 3 customers?
From top 3 customers?
Top 3 customers, yeah.
Top 3 customers would be roughly 50%, 55%.
Okay, sir. And is this going to change post, we are shifting from medium casting to large casting?
No. This will not change because they are primarily the same customer with which we are moving ahead with same customers only, and we are increasing our share of business with existing customers. Because you see our top 3 customers are M&M Swaraj, TAFE, Escorts, and these are our major customers, and these are top 3-4 tractor manufacturers in India. So they control almost 60-70% of the market share, and we are majority growing with them only.
Okay. And so my last question is that, are we preparing for some EV related opportunities, or that's out of picture right now?
No, EV also, as of now, if we see tractors or other EV, everybody is developing, and we are also developing components for them also. But as of now, we don't see any major EV platforms coming in tractor for next 2, 3 or 5 years. It's a very small, in a very small way, all the companies are working on it, but not in a big way.
Okay. Got it, sir. That helps. Thank you so much.
Thank you. Ladies and gentlemen, to ask a question, please press star and 1 on your phone. Next question is from the line of Yash Parker, an individual investor. Please go ahead.
Please repeat the name.
Yash Parker.
Hello, am I audible?
Your question? Yes.
Yeah, you're audible.
Thank you for the opportunity, and congratulations on good set of numbers. So you mentioned that the rising cost was nearly 4 to 5%, And we also saw that there was a lot of increase in the steel prices and power and energy costs in the last quarter. So how do we see the cost environment evolving going forward for FY27?
The cost, that I told earlier, if there is no major disruption because of war, then I think the cost should stabilize. Only thing is now with the diesel prices now increasing slowly and steadily, so that will have some impact on the freight part on the other thing, incoming raw materials and all those things. So, but good part with Indian OE is, I mean, everything is pass through. I mean, there can be delay, but it happens. So raw materials is already on a pass on. Other things like freight and other things, I mean, they do pass on, and maybe with a delay. So, I mean, I don't see a very major impact of these cost pressures for a long term. Yeah, short term impact will be there, but not on long term basis.
Okay, sir. Another question would be, sir, regarding the EBITDA and realization. They have improved quite a lot in this year. So is this because of some value-added products that has contributed to such a good improvement?
There are two reasons. One, value-added products. Then number two is better utilization of the capacities, and these are the two major reasons.
Also, sir, what would be the comfortable leverage range for our business over the medium term? Right now, I guess the net debt to equity somewhere 0.65 or something. So how comfortable is the management on debt part?
The debt part, we are, as on debt equity is concerned, we are sitting on a comfortable position. And I mean, for future expansion also, we see I mean, we will keep it below 1. We'll keep it below 1 in any regard.
Okay, sir. And also, sir, regarding the future opportunities. So you have mentioned that infrastructure spending, the commercial vehicle demand increase, and even the vehicle scrappage policies are going to be a growth drivers for us. So out of which segments or applications do you feel would drive major growth for us?
See, as of now, we see major growth in tractors. CVs, because of lot of regulation disruption, has been going up and down. CV has been more volatile than tractors over the last 5-7 years. So we see a major growth in tractors as well, because all the governments have a lot of focus on rural income. Rural incomes, everybody, I mean, right from center to state governments, they want rural incomes to grow, rural people, and you know how election machinery has become now. So government has a lot of focus on rural economy, and we see another for next 4-5 years good growth in tractors. There may be a year or a year and a half of a dip, but on a long term basis we see a good growth in tractor industry.
So last question, you also mentioned that we will be starting with production in the US. So could you quantify what would be what can we expect as in the margin difference between India operations and US operations, please?
See, I mean, what we have studied till now is that if we work at 14-15 EBITDA margins, and if we, I mean, do a major, like manufacturing over there means not full product manufacturing, only a part manufacturing or a finishing part of kind of thing, that finishing operations, like something like that only. So we expect that margin minimum say EBITDA margins of 18 to 20%.
Oh, that's great. Last question from my side, sir. You mentioned that tractor so far is not adopted for EV. But how about commercial vehicles and off-highway equipment segments? Like, are they adopting the EV thing now?
No. Heavy commercials, there some very slight movement. That is only in buses there, but not in commercial vehicles, heavy vehicles. Tractors they have just started a development, or maybe a very small amount. And for off-road vehicles like construction equipment, I have not seen any movement in that towards electrification.
Okay, that answers my questions. Thank you so much, sir.
Thank you. We'll take our next question from the line of Vishal from Swan Investments. Please go ahead.
Thank you for taking my question, sir. I have a few questions regarding the CapEx details which you have shared.
Regarding?
80,000 metric tons of capacity you plan to achieve this year, where you are adding 8,000 metric tons.
Yeah.
And plus next year you plan to increase it to 24,000 tons. So, what kind of investment you plan to do this year and next year, if you can share some detail, and how will it be funded?
This year it will be, we are planning to invest around 25 to 30 crores. And next year when we go for a bigger project, that is about 2004, that time we are looking at a investment of say around 60 to 70 crores. And that we will try to fund it by a combination of debt and equity. This year it will be by debt only, and next year will be by debt and equity.
Okay. Because sir, debt has increased quite meaningful to this year around 190 plus crores.
180. Yeah, this year is 180. Yeah.
And our interest cost is also around 22 crores. So that will add extra burden to your.
We will this year we will do by debt only. Next year by combination of debt and equity, or maybe we will see what kind of equity we are able to raise. It will depend on that, but that is the plan.
Okay. And the increase is 2,400 tons will be only through LFP, right? If I'm not wrong.
Pardon?
The increase in the capacity is for the LFP products, right?
Next year would be LFC.
Okay. So after this increase, what will be the share of capacity between the normal conventional casting and the LFP?
After next year, it will be around, say, 70-30.
Sorry, sir, you're sounding a little distant. Can you come closer to the mic, please?
Yeah, it will be 70-30. Next year, it will be 70-30.
Okay, 70-30.
Yeah, when we add this 2,400 tons, so it will be roughly 70-30, 65-35. Anything between 70-30 and 65-35.
Okay. Sir, what is the current share of business or the share of revenue between the conventional and the LFP currently?
Currently, LFC is roughly, say, 15%, 10 to 15%, yeah.
Okay. And we were planning to add certain more customers in the LFP. It was few of the OEMs were testing our products. So where are
we are under discussion with customers in India and abroad. Last year we added one customer, domestic customer in India for LFC, which was Kion India. So that was a import replacement product. And then we added one customer in South Korea for LFC product, for which the consignment is going this month for Korea. For Kion, the Indian customers, we have already started the supplies.
So in terms of your order book which you have currently, so what is the proportion of LFP products?
As of now?
Yes.
Order book, if we say, is LFC is almost 20%. Order book what we have.
Okay. What is the size of order book currently? What is the overall size of the order book currently?
Order book is, we are fully booked. All 70, rather we are overbooked as of now. What demand is being generated by customers, we are overbooked on that.
Okay, so it will be over like 500-600 odd crores of order book currently we have?
Yes, easily.
Okay. And sir, what is the margin profile of LFP generally we envisage?
Generally, it is, say, 1% or 2%, 1 or 2% higher than the normal one.
Okay. Okay. And sir, what is the like-to-like basis in terms of CapEx between the LFP and the conventional in terms of per ton basis? Does the LFP CapEx are far lower than?
Yes. If we say for a greenfield project, not a brownfield, only greenfield project, for the categories where LFC is used. LFC is used basically in large castings which have a high core part. So their minimum capacity created is 3,000 tons. For that minimum you need 120 to 150 crores depending on the land and automation you add to that. Whereas same 3,000 tons in LFC you can put in 75 crores. It's almost 50%.
Okay. Thank you.
Vishal?
Yeah. Hello?
You're through? Or you're asking questions?
No, just one more last question. Share some details on how the funding would be there for the next leg of CapEx. That will have some clarity on.
For next leg, I told you it will be a combination of debt and equity.
Okay. Sure. Thank you.
We will raise some equity and debt also. It depends. We will prefer if we can do it fully with equity and as much as equity as possible and less of debt.
Okay. Thank you so much and all the best, sir.
Thank you, Vishal. Thank you.
Thank you. Ladies and gentlemen, to ask a question, please press star and 1 on your phone. Next question is from the line of Manas, an individual investor. Please go ahead.
Yeah, sir, just had some follow-up questions. So I just want to understand, are we doing some ex-works model or is it like we take some companies, they have ex-work model. Some companies, because then they are not bothered about their these pass-on costs. Are we looking to move to a transform to ex-works model?
The customers who are far away, like M&M and Tafe, we have ex-works. And for customers who are near about, like Swaraj is there, Scotts is there, we give them on free delivery basis. And secondly, the diesel component, the freight component which you are considering is not only on ex-works also, on the delivery.
Okay.
It is also, it impacts the incoming raw materials also. So that is how it impacts. Incoming raw materials also become costly because the freight part increases.
So now how do we feel? Still the prices are there. Now in the upcoming quarters, we feel that the margins will be better. So on what basis we feel that we'll be able to come back to the
margin will be better
level margin?
Because other than the freight part, most of the raw material will be passed on by the customer in this quarter. Whatever increase was last quarter, it will be passed on. So only freight component, because that started the diesel started increases this month only. So that we have to see with our customer how we go about that. What is the quantum? Because still it is not closed. Every day it is increasing. So once that stabilizes the diesel, then we will start discussing with our customer.
Okay. So you are saying majority part will be passed. So it's like quarterly you are passing on, monthly now at this point. How is it? How are we doing it at this moment?
See, at this moment it is different. For some customers it is quarterly only. For some it is, we have moved to monthly. We are moving to monthly. It is under discussion.
Okay.
So that is how.
Okay. Yeah. Okay. So, and the second question was, I see in last 2 quarters, last 2 years, I've been noticing March onwards our margin dips, maybe by 2% or something. I've seen for last 2 years. And again, this year also we had a hit. Obviously, there is some element of raw material cost, but also I think the press release you hinted for the product mix. So my question was, how much of element of this is the product mix? Is March quarter where a particular customer we are serving, where we have less margin or what? Because last 2 years I have noticed the March quarter, the margins are down 2%.
Normally what happens is, by the end of year, the raw material prices start going up. So that is one part. Or maybe in last to last year was that it was lower capacity utilization was there. So it depends on various factors: raw material prices, capacity utilization, and then
on similar turnover also we are ahead. Suddenly the margins took a dip, like 16, then suddenly it goes to 30.
Raw material prices, product mix, sometimes the products which are old products where the value addition is less. So their volume increases. But tractors have now a lot of product mixes there. Different types of products are there.
But since you're fully doing machined components, the margin profile should be very similar. It should be like your base product mix should be very, very.
What happens is the components which were settled, which are say we call legacy components. Okay. So there the margins have over the years reduced. But in new components the margins are better than the old ones. So that is one of the reasons.
Any idea, a percentage? Any idea? Just to understand, like.
What percentage?
Any percentage means legacy versus the new components. At least you have some idea over that. Any idea? Any numbers you have to it? No?
As of now, we say almost it will be a ratio of 60-40. 60 would be legacy, 40 would be new.
Okay.
So legacy components take long time to move out of the system. So the product customer also the tractor models take long time to just.
And it might be with the particular customer as well.
Yeah, particular customers also.
Yeah. And the last question, I think a little bit I understood the structure. Meta casting is there, Pritika engineering component is there. Pritika Auto also does some machining. So Pritika engineering and Meta casting is there. I just wanted to understand, is Pritika engineering and Meta casting gives the job back again to Pritika Auto to do some machining, or it's built from entire three different entities to the final customer?
Some products they give raw casting and Pritika Auto does the machining. Some they do the machining and just bill it to Pritika Auto.
So the billing is happening from both the ends, the Pritika engineering and Pritika Auto. Earlier con calls, I studied that earlier it was different, so I just wanted to understand that.
No. Billing is done by both the ends.
Okay, so sometimes the casting comes from Pritika engineering and goes to Pritika Auto also.
Yeah, goes to Pritika Auto, machines it. Sometimes Pritika engineering does the machining and bills it to Pritika Auto.
Okay, so both ways it happens.
That is both ways it happens.
But is there any, is there because of operation reason it's like this, or?
Yeah, operation reason we try where like Pritika Auto is more into small and medium castings. Okay. And Pritika engineering into medium and large castings. So sometimes the medium castings go to Pritika Auto and they are machined over there.
So the margin discovery happens then at the Pritika Auto then? Because then you bill it there, then the margin discovery happens there.
Yeah.
Am I right?
Yeah, you're right.
And sir, the last question, I remember you told now next year, see we are generating 70 crores cash this year. If I assume next year also you generate 70 crores cash and 30 crores you want to do some capex and remaining 40 crores will end up going in some interest cost and 20 crores you might repay some debt. I don't know. I'm just giving a guess. And that might come down to 170 odd crores. Then the next year following that you want to do 70 crores capex. Assume you will also generate similar cash flow, 50 to 70 crores. So is there a real need for debt? And is there you might need some debt, but I don't think the debt component should go up disproportionately.
We'll see the cash flow and how we are placed. Then take a call on that.
But I'm assuming this cash flow trend will continue in the.
Yes, it should continue. It should continue.
Okay, sir. Thank you so much. Thank you so much.
Thank you. Next question is from the line of Rohit Mehra from SK Securities. Please go ahead.
So thank you for the opportunity. I joined late. Maybe I'll be repetitive. I just wanted to know, so margins were gradually increasing from FY22 to FY25, and this year we saw decline in EBITDA margins. So may I know the rationale behind that?
Basically, it has been in Q4, and it was because of the increase in raw material prices, and then disruption due to war in March. because in gas and other things, there was a lot of disruption was there. In whatever the chemicals, crude-related products were there, there was a lot of disruption in that because of that.
Okay. So, is it fair to assume that so we will maintain the margins around 15 to 16% going forward?
Yes. Coming year, this year, and if there is no further disruptions due to war, we should reach back to our original margins.
Got it. Also, the company has invested in lost foam casting technology from Mita Casting, obviously. So could you elaborate on the strategic advantage of this technology and expected business contribution going forward?
See, at present, business contribution is around, say, 10%, 10 to 15%, because this is a new technology and it has taken some time to establish it at our end and at the customer end, but now it has been fully established and we are ramping up our production. The basic advantage of this casting is that if you see, this is primarily used for large casting, or with the casting, the core work is very high. The core content is high. So, for that kind of a product line, whatever investment required is minimum is 120 to 150 crores. But with LFC, we can produce same product with same quality with almost 50% investment, and in a smaller blocks. So that is a 3,000. Here we can start with 500 tons, 1,000 tons, 1,500 tons. That way we can create the capacities in that. So it is much easier with lesser capex. You can start this technology, and then you get the same quality, same product, and slightly better margins in this.
Got it. So going forward, is it fair to assume that this percentage that you told me that right now it is 10% will go upwards to 20, 25 or maybe more?
Yeah. That is a long-term opportunity to take this to 30% in next 3 years.
Got it, sir. Okay. And apart from the US market, are there any new export customers or geographies currently under discussion?
We have recently started exporting to South Korea also. We have sent one lot and one lot more is going. And we are exploring Europe also in this regard.
Okay. So how are we competing so in this market compared to this Chinese and European foundries?
See, whatever advantage they had because of low cost thing, low cost manufacturing, because of labor cost and other power costs. Now that they don't have that advantage. Only advantage they have now over above is number one is the financial cost, and number two is productivity wise. Otherwise, their labor cost is higher than us, their power cost is higher than us. So India as of now is India can compete very easily with China, which was not possible, say 10 years back or 15 years back.
Got it, sir. Thank you. That's answered my questions. Thank you and all the best.
Thank you.
Thank you. As there are no further questions from the participants, I now hand the conference over to Mr. Harpreet Singh Nibbar from Pritika Auto Industries Limited for closing comments. Over to you, sir.
Thank you. In closing, I want to acknowledge the sustained effort of our teams across manufacturing, quality and supply chain. Financial year 2026 performance has been delivered through disciplined execution. I also thank our customers for their continued partnership and our investors for their engagement. I would also like to say that our company, we are on route to fulfill our vision of 1 lakh tons, and we are very aggressively following that our vision, and we plan to growth. We have that's by 15% for next 2 to 3 years, and we will be continuously adding capacities and customers. And our focus would be for next 2-3 years would be exports. I know it's a long-term process, 4 to 5 years. So we will be focusing on exports so that our margins can improve. And second would be railways, which again we are very aggressively working on 2-3 products, and we hope that another 2-3 years, so that will also give us a good revenue and bottom line. So financial 26 has validated the operating model we have built, consistent revenue growth, improving product mix, and broadening strategic agenda. We will carry that forward in coming years also. Thank you, everyone. Thank you for your time. Thank you. Have a good day.
Thank you. On behalf of Pritika Auto Industries Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.